First of our guests are with us, Arvind Sanger, Managing Partner at Geosphere Capital Management, and Brian Jacobsen, the Chief Portfolio Strategist at Wells Fargo Funds Management. Good evening to both of you. You'll have stayed up for us. Thank you very much. Brian, how much of the QE has been factored in by the euro at all? We were just discussing the QE of the dollar. In September 2012, saw the dollar getting debased all the way to from 1.2 to 1.4 over 2 years. In the case of the yen, it started falling from 93 to 119 today. Ever since April 2013, saw that QE getting announced. So is euro-dollar parity absolutely a given now?
I don't think that it's absolutely a given. It may happen, but I think that would actually take a number of years for it to reach parity. And the big reason is because what the European Central Bank has done with its monetary policy, in order to actually get to parity, I think we would need to see a tremendous takeoff of bank lending. And so it's not just enough for the European Central Bank to go out and purchase assets. That actually has to be translated into more credit growth and a little bit more inflation. Now, if the U.S. Central Bank, so that's on next Wednesday when the Federal Reserve meets, if they come out with a fairly hawkish tone to their policy statement, that could push things a little bit closer to parity. The scenarios that I'm looking at right now is for the euro at sort of a worst-case scenario to go down to about $1.09. But I think that over the course of 2015, the most likely scenario is that we'll actually see it drift back upwards towards around $1.25.
Okay. Well, Arvind, what does this mean to fund flows? First of all, do you think that there will be more depreciation of the euro? And more importantly, where does this huge tidal wave of money go? Would the US and the Indian markets, being relative outperformers with a growth delta, be the biggest beneficiaries?
Well, I think that, first of all, I'm certainly not a great currency expert, but clearly the euro weakness has already happened to a great extent. And I think, as Brian just said, it could bounce around here. But I would say that I think one of the interesting questions we have to ask ourselves at this stage is, what is the Fed going to do? And is the Fed going to continue on the path that they have been on? And they may talk hawkish, in the very short term. But the reality is, are we really going to see a rate increase out of the U.S. Fed by mid-year, as many are expecting? And I, frankly, am getting a little more skeptical about that because, frankly, a strong dollar does have negative consequences for some U.S. companies' U.S. growth. And a strong dollar also keeps inflation, along with lower commodity prices, extremely quiescent. So, there is a risk that you could see significant job losses in the shale-related oil industry, which could cause, some near-term negative surprises over the next couple of months in terms of unemployment numbers. The benefit of lower oil prices is not going to show up as quickly as the costs on oil and gas industry, high-paying jobs. So all of that suggests that I think one of the interesting debates that could continue for a few months is how quickly is the Fed going to take off. And if the Fed takes a pause, then this party is really, really going to go much further than anything we've seen so far. In any case, clearly funds flows from this QE, I frankly remain skeptical that we're going to see any dramatic economic acceleration in Europe from QE. We will probably get some modest help, but that liquidity is going to go hunting for where growth is more visible. And right now, obviously, India and U.S. are the two places I feel more comfortable betting on the India growth. U.S. with a stronger dollar is facing a little bit of a headwind in terms of the growth dynamics, facing some negative challenges.
Arvind, hi, morning. Just for the near term, have global equity markets factored in the QE by the ECB, or do you think there's more to go on the upside?
I think, some of it was factored in, but I think there was still some questions. I mean, the U.S. market had a very strong day today. I think there was some questions as to how much would there be, and I think the positive surprise from today's announcement, if I were to take one away, it would be that there seems to be an indication that the QE could be open-ended until inflation, reaches that 2% target. Now, it's not obvious that that's where it's headed, but that's kind of something that seems to be a fairly reasonable read between the lines, but I'm not sure that that's certain, but that's what the market's kind of betting on. On the other side, the small print of mutualization of the losses being a very small percentage is a modest negative, but at this point the market is choosing to focus on the positive. So I think that it clearly is not fully discounted, and I think we can continue to see some rally out of this QE.
What about you, Brian? Where do you think the liquidity will go? What will it chase? Which assets will benefit?
Sure. I think that actually one of the key things with the ECB's latest move is it's really shifted sentiment. It is going to help get global investors out of almost a rut of sentiment where it's always been this will they or won't they do anything. And we know now that the ECB is sort of all in on trying to support economic growth and a return to their 2% inflation target. Most of the liquidity from the ECB's move, I think, is really going to be in the carry trade, so to speak, where perhaps, borrowing in the Eurozone and then buying higher yielding assets, and so that's probably going to keep U.S. Treasury yields lower. It's also going to, I think, squeeze investors into some of the riskier areas of the market where people can find maybe some of the momentum plays. I believe on one of your previous guests had talked about quality stocks in India, and I have to agree that I think that India was a tremendous place to be investing in 2014, and I think that it's going to continue to be a good place in 2015. So I think that it's going to have repercussions throughout the global financial markets. But one of the big turns here is the banking system in Europe is finally in a position where it can actually take some of this quantitative easing and translate it into lending to the private sector economy. And I think that we could actually see some upside surprises on the growth front coming out of Europe. So I actually think that this is a major bullish signal for the global financial markets in general.
Arvind, for the Indian markets, yesterday we saw the Sensex close above the 29,000 mark, so it's uncharted territory for us. Do you continue to buy stocks that have been rallying so far, like banks, etc., or do you change your stance now?
Well, I think it is always tricky. As I think you had guessed earlier, Anuj, talking about quality stocks will keep going up. I don't disagree with that, but I guess I still try to find growth at a reasonable price. And frankly, there are still companies which seem expensive on current valuations, but if you believe that there is a domestic cyclical earnings recovery, which could be pretty powerful in areas like, the infrastructure side, or let's say, in the CV side, or many other sectors where stocks look expensive on a current earnings, and even some of the financials. But if the earnings continue to grow and start to accelerate, then I think the market is going to look much further ahead, given, again, the paucity of growth visibility in most parts of the world. Therefore, I don't think it's time to take the foot off the gas pedal, but, I guess I'd be selective.
Okay. What about you, Brian? You agree with that chasing quality stocks. What would you look for? Would you look for, classical cyclical stocks? And would you avoid stocks like Infotech, where the exposure is to the dollar? And basically, where do you see the dollar rupee if you are looking at it? Would you see a lot of appreciation or at least stability in the rupee and that attracting more flows?
Yeah, on the currency front, I think that's going to be a bit of a conundrum because, we recently had the rate cut coming out of India, but yet we're probably poised to be having a rate hike at some point, if not the middle of 2015, the early part of 2016 in the United States. And so I think that the currency volatility could be a rather interesting play. I try to look through that a little bit and look at the fundamentals of the companies where It's more looking towards that longer-term growth picture. So as Arvind was saying before about looking not necessarily about valuations relative to the maybe next 12 months earnings, it's more valuations relative to the next 5 years where it can really be. And that, I think, is kind of broad-based where you can look for opportunities. I like the infrastructure play, but I also like the banks. I also like some of the cyclicals. So it's almost a grab bag of some of your, just look at each sector, I think, has something to offer in it.
Okay. Just one word on what the expectation is from the budget this time around, Arvind, because the feeling is that a lot of the work is getting done outside the budget itself. So in a sense, the budget may not be such a market-moving event eventually. What is your own estimate this time around?
Well, I think, yes, the budget by itself becomes less important in a policy framework where policies are made, on an ongoing basis. So I've always, been surprised how much attention the budget gets. But having said that, I think one of the clear signals we need to get is, a more realistic pathway in terms of some of the major issues, whether it is subsidies or it is capex or other investment by the government. Which way is the government going in terms of its major priorities, and the budget provides some framework for that. The policies that will need to be put in place are going to come separately, but I think the budget is still useful, and I frankly, was disappointed with the last budget, even if it was a bit of a rush job that this government presented. So I'm hoping for a more comprehensive medium to long-term perspective presented by this budget in terms of how, and with the Arvind Panagria at an advisory body, NITI, I'm hoping that we will see a more clear idea about how the government's priorities, medium and long term, are going to shape up in terms of investment versus subsidies versus other competing initiatives.
Okay, Brian, I was interested that you're speaking about the market getting used to multi-year valuations or talking of 5-year valuations. What really are you looking at in terms of, say, a nifty level in the next 6 months or in a year, whatever is your comfort zone? As well, do you expect rate cuts in India to be hastened now? And how many would you expect?
Well, I hope that the rate cuts are hastened because, when you're looking at an interest rate that's, close to 8%, I think that taking 0.25% or 0.5% steps is fairly small. If anything, I think that it was a good signal that this is the direction that they're heading, is to cut rates because, let's face it, with falling commodity prices, especially with energy prices, that's going to apply some give them a little bit more flexibility in dealing with taming inflation. So I think that they can really shift monetary policy away from trying to stop the rise of inflation towards promoting more growth. And so you now have a situation where on the fiscal side you can promote growth, and also on the monetary side you can promote growth. So I think that we will see a series of rate cuts. At what point does it stop? I'm not exactly certain. I think that actually a target of around 6% would be very reasonable. But I'm not in the position to make that determination. I'm not quite sure if Rajan would actually go for something that low at this point. So the rate cuts, though, I think are headed in the correct direction. Now, as far as on the valuation side, as far as where we should be looking at is with India, I still view it as, even though it had a tremendous run in 2014, is for 2015 we could be looking at. I have kind of penciled in a 20% upside here. So I still view India as one of my favorite markets to be investing in.
Your levels, Arvind?
I think I agree with Brian. I don't see any reason why we couldn't get, if the Nifty today is at 18, high 18 or 1800s, there's no reason it couldn't be in the 2200, so about a 20% upside by the end of the year. And frankly, it could exceed that if we see one of the things that has been somewhat surprising, which is why I think you could get a bit of a rubber band effect, is that the economic recovery in India has been extremely sluggish for the last 9 months. While we've heard a lot of optimism, but we haven't seen follow through. I think this could be a little bit of those spring-loaded effect where you could see a very sharp rebound when it starts to get going. And if that happens, then, back end of the year, you could see even bigger moves because the earnings recovery could be much faster than people expect.
All right. This was a most interesting and informative conversation. Brian, Arvind, thank you very much for staying up for us. We have been that much the richer.